In today's video, I'm gonna comp creative finance deals. I'm talking subject to and seller finance. I'm gonna look at these deals and see if they are a good fit for my personal portfolio and if I should buy them. In this video, you'll learn what a good subject to deal is and what a bad seller finance deal is. These are all real life examples, not made up numbers, submitted by amazing wholesalers and investors in my free Discord group. The Wholesalers is the #1 real estate wholesaling and creative finance investing community on Discord. Y'all should absolutely join. Okay, let's look at a few deals. This property in Georgetown, Texas was sent to me by Alice, so thank you. She said the purchase price was $450,000 and it was a seller finance deal, meaning all you had to do in this case was put 15% down, so give the seller 15% cash, which quick math is like 70 grand, and then the other 330,000 you could finance to him in monthly payments. Just pay him every single month like a bank. That's awesome. You don't need a lot of cash to buy this house, and you don't need to qualify for a mortgage, so you don't need credit and you don't need credentials. Anybody, you could just go and get this mortgage from the seller, not from a bank. A seller finance deal. It's great, but is that a good deal? Well, guys, in order to know that, we gotta ask a few things. We gotta understand the terms. And guys, there are 5 terms in a creative finance deal. Purchase price, the price, and like Pace Morby says, you the seller, you can have your price, I just need the terms I need. So Pace gives them the most important term to them, the price, and he tries to take on the other 4 terms, the one that matter to him. Interest rate, down payment, amortization, also known as loan length, and I'm dyslexic or whatever the heck I am, and I always spell amortization with 2 M's, so I fixed it this time. And the last one, you guys are like, there's another one? Yeah, balloon. Guys, don't forget about the balloon. So if the seller wants $400,000, I think that's expensive for this house. So if I'm gonna pay up for the house, I really need good terms. So if this is $400K, which is a lot, I need a good interest rate, a good down payment, a good amortization, and a great balloon. Well, Alice told me that the seller wants a 5% interest rate, which between us is not bad. Is it amazing? No, but it's not bad at all. Down payment, he wants 15%. That's a little high for me. I'd like to be under 10%. The amortization, 30 years. So honestly, guys, this is not a terrible deal yet, but this is where it ruins it for me. He wants a 5-year balloon. Guys, I hate balloons. Balloons are for clowns, as Pace Morby says. So this is a dead deal for me. Balloons in commercial, multifamily, totally fine. But like the whole point of creative finance, guys, is we negotiate great terms for the long term. And if you're just going to put a balloon in there and I need to pay off the entire mortgage balance, the entire debt to the seller, the rest of that $330,000 in 5 years, then what's the point of negotiating this deal? I'm trying to get good long-term debt for 30 years, not for 5 years. So what we're going to try to look for in these seller finance deals or in these subject to deals is something that I call the 5-10-12 rule. Less than a 5% interest rate, under a 10% entry fee. So think down payment if you're new, but there's a few more things that go into it. And then get a cash flow of hopefully over 12% cash on cash return, which is very difficult, but that's what we're going to shoot for. We didn't even talk cash flow in this example because honestly, the balloon just kills it for me. I'm just not interested. If Alice can go back, get rid of that balloon, then I might be interested in this deal, but I still would want that down payment to go under 10%. I got 18 minutes. Let's fly through a few more. Before I jump into our first subject to deal, I was actually sent another seller finance deal by Davis, but this one has a bigger down payment. So y'all, what do you do when the down payment's huge? I'm talking a big down payment, over 30% down. Somebody wants 40% down, 50% down, 60% down, 70% down. They want a big portion of the purchase price in cash and then the rest will seller finance. Guys, immediately do Morby method. If you want to learn more about what that is, I mean, check out Pace Morby's channel, and I'm going to make a ton more videos on Morby method. I'm going to break down Morby method so that your 5-year-old can understand. And another thing that I do to help 5-year-olds is I write children's finance books. So if your kid wants to learn about finance, well, they probably don't, but if you want to teach your kid about the difference between gold and money, what inflation is, or even my other book, Black Swan Sanctuary, on what the Federal Reserve is, Paul Volcker, Jerome Powell, monetary policy. Guys, I teach all of that with my children's books. Make sure to pick up a copy in the description down below. Okay, 15 minutes. Okay, this next house was sent to me in Indianapolis. Now, I probably won't buy in Indianapolis, but I'd like to look at this deal anyways. It's a good example. I mostly buy here in Dallas-Fort Worth. But this was a subject to deal. The purchase price was $120,000, and they had a loan balance of $96,000. Immediately, I'm thinking that's not too much equity. This may be a good deal, and the house doesn't need a lot of work or any work. It's a good long-term rental as it is. So now I'm trying to figure out, okay, what's the interest rate? The interest rate is a little high. It's like 6.5%. A little bit over my 5%. I don't know if I'm going to want that deal. That's not a great rate, But if there's some instant equity in this property, if the property also cash flows at a 6.5% interest rate, which I don't know how that's possible, but maybe it does, then yeah, I could be interested in this deal even though the interest rate's high. Especially the instant equity, guys. If I can get a property that has a 10% interest rate, but I immediately have 30% instant equity, oh, well, yeah, that's a great deal to me. So don't sleep on equity, guys. If you're overpaying for properties, you actually lose a lot of options. You can't do a lease option. You can't do a wrap. You can't do a refinance like a SIR. And you put yourself at risk of bankruptcy in case you have to sell the property. You won't be able to liquidate it for what you're in, and you're going to lose a lot of money. So guys, don't overpay for sub 2 deals unless you're sure you can hold on to them for the next 30 years, which unless you're Pace Morgan, you have a big war chest of finances coming in every single month to sustain you. Be very careful with overpaying for sub 2 deals or seller finance deals for that matter. But anyways, guys, this property, the interest rate's just a little bit too high for me. And what you would want to do is run comps. And I don't think it's worth over 120,000, which is crazy. A house for 120,000 that's in good condition, but Indianapolis is different than when I live. So if I'm getting a house at break even and I don't get a great rate and I still have to come out of pocket like 20%, not the right deal for me. If this was a $0 down deal and I was just pretty much given this house, you know, like, hey, continue to make the payments and I could rent it out and break even, might be interested. Remember that 5, 10, 12 rule, y'all. Okay, 10 minutes. Okay, hold up. We may have a good deal here. This property in Fort Worth is currently for sale. They originally had it listed at $465,000 about 3 months ago. Oh, wait, 4 months ago. And they've been steadily dropping the price to now it's at $435,000. If they have a mortgage balance of say $400,000, guys, which I'm just guessing they do, I don't know. Well, it costs 10% usually to sell a house between realtor commissions, which is 6%, between closing costs and between buyer concessions and all the other stuff. So that means if you have a $435,000 house, 10% of that's almost $40,000. That means they'll be netting like $390,000, which if you have a $400,000 mortgage, that means you're losing $10,000. So when they sell their house, guys, they literally will have to pay the bank $10,000. So what we can do as creative finance investors is we can come in and be like, hey, I'll just take over your mortgage of $400,000 and give you no money. You save $10,000. I'll pay the realtor fees. I'll pay the closing costs. I'll just take over your mortgage, pay for everything. You walk away with no money. That is a good offer, but that's dependent on a few things. Is the interest rate good? And guys, I mean, they have to have low equity, right? So let's actually look at the deal. Come on, please have low equity. Please have low equity. No effing way. Guys, Anthony sent me this property. He says he can get it for $410,000, but this is the more important thing. The mortgage balance is $406,000. It's even higher than we thought. They have no equity. If they were to sell their house right now at full price, they'd literally be bleeding and losing a ton of money. Okay, this is great. This is great. This is great. It's a great. Oh no, guys, this property is at 4.75% interest. It's under our 5%, but it's still high. It's a lot higher than 2.5% interest. So cash flowing on this property is going to be brutal. So the thing with Texas is, y'all, it is tough to cash flow on a long-term rental because, guys, taxes here are brutal. This house could have $700-800 in taxes a month. We'll go look at the numbers here in a second. Some of my rental properties, I'm paying $1,000 a month in taxes, which kills your possibility at cash flowing if you don't have like a 2% mortgage, or you're not doing some creative exit strategy like wraps, or if you want to keep it as a rental, like a short-term rental, which is now illegal in half of Texas, or midterm rentals, or pad splits. That's why pad splits are becoming so popular here in Texas. So anyways, we'll look at this deal, but I'm worried it's not going to cash flow. But guys, you can get the deal for no money, which is pretty cool. Anthony's telling me that the principal is $569, the interest is $1,600, and the taxes and insurance are $1,500. And there's an HOA for $33 a month, so you can't do a creative midterm rental or pad split. So it has to be a long-term rental. Unfortunately, I think this deal is only going to work as a homestead. This is a great property for someone looking for a primary residence, but not so much a deal like, an investment property. Because guys, the issue with this house is that your monthly payment right now is $3,700 and it only rents for like $2,500. So that's a $1,200 loss. But if you are looking for a primary residence, guys, this is an amazing deal. Just the HOA really kills the opportunity to do anything creative like a pad split or like a short-term rental. So options here, something I'm thinking is this could make for a good lease option property, a great lease option, or this could make for a great wrap potentially. I'd have to run the numbers and see what the actual value of this property, but if you can get it slightly under market value, then you could wrap it. And it could be a great wrap. Now, if that was all gibberish to you and you're still confused, guys, don't worry. You will completely understand what I'm saying if you watch more of my videos. So make sure to subscribe. Hopefully this was helpful in looking at deals. This last one we look at still has potential. I'm not going to throw it away just yet. The issue with this property is that they're so in the negative that you would need to convince the sellers that they need to be open to losing money. So if they're open to paying their realtor commissions and paying their closing costs, then this could be a good deal where you could come in for literally no money, take over their loan, and then get appreciation and depreciation, but you're losing money as a long-term rental. Now, between us, these numbers don't seem 100% correct. This $400,000 house, I mean, I know this market pretty well. I thought taxes would be like $700 a month, and then insurance should be closer to like $200-300 a month. So let's say $1,000. I was told this was $1,500. So now we're not losing $1,200 a month. Now we're just losing $700. But the issue is, guys, even if it's like, oh, Max, that's not that bad. After you factor in maintenance, vacancy, capital expenditures, and I know you're like, oh, Max, the house is brand new. Well, what about management? You're probably still losing a lot of money. You could be losing up to $1,000 a month. So this one's tough. It may be a good fit for somebody, but it's not a good fit for my personal portfolio at the moment. I hope you guys appreciated this video. I ended 2 minutes to spare. I love y'all so much. Make sure to subscribe, and I'll see you guys in the next video. Peace.